What if I told you that one of the best performing large-cap stocks of the last decade also happens to sell groceries? Since 2015, Walmart stock has delivered strong total returns, helped by a business model that most investors still underestimate. In February 2026, it became the first traditional retailer in history to be valued at over $1 trillion. And in December 2025, it transferred its primary listing from the New York Stock Exchange to Nasdaq. Something inside this company has changed. Today, we're going to break down what that is. This is a full look at Walmart, ticker Walmart, from a two-room discount store in Rogers, Arkansas, to one of the most complex business systems on earth. We'll cover the origin story, how it makes money now, the real risks bears are pointing to, and the bull case for why Wall Street still sees room for the stock to work. Let's get into it. To understand Walmart as a stock, you first have to understand Walmart as a company, and to understand the company, you have to understand the man who built it. Samuel Moore Walton was born on March 29, 1918, in Kingfisher, Oklahoma, during the tail end of the First World War. He grew up working on his family's farm during the Great Depression, an experience that shaped how he thought about money and value. He understood what it meant to stretch every dollar. After serving in the U.S. Army during World War II, Walton bought a failing Ben Franklin 5-and-dime store in Newport, Arkansas. He was 27 years old. He borrowed $20,000 from his father-in-law and put in $5,000 of his own savings to make it happen. He turned that small store into the top-performing Ben Franklin franchise across a 6-state region. He was in the store before dawn, talking to employees, tracking numbers, and pushing for constant improvement. Then his landlord refused to renew the lease and took the concept for himself. Walton lost the store he had built from nothing. He walked away with the business knowledge, but little else. So he started over. He moved to Bentonville, Arkansas, opened Walton's 5 and 10, and spent the next decade watching, learning, and refining. Then, on July 2, 1962, at the age of 44, he opened the very first Walmart in Rogers, Arkansas. The sign on the front wall read, "We sell for less. Satisfaction guaranteed." That was the whole idea. Pass savings to customers. Keep margins thin. Make it work through volume. And just as important, Walton avoided head-on competition with the biggest chains. While Sears and Kmart focused on cities, he went after rural towns they had overlooked. In those places, a Walmart could become the only real retail option for miles. He called it his saturation strategy: cluster stores around a distribution center, dominate the local market, then repeat the model in the next town. By the end of the 1960s, he had 18 Walmart stores and 17 Ben Franklin franchises across 4 states, generating over $30 million a year in sales. On October 1, 1970, Walmart went public, offering 300,000 shares at $16.50 each. 2 years later, on August 25, 1972, the stock moved to the New York Stock Exchange under the ticker Walmart. The growth that followed was staggering. By January 1980, Walmart crossed $1 billion in annual sales. By 1990, it was the #1 retailer in the United States. By 2002, it sat at the top of the Fortune 500. Sam Walton died on April 5, 1992, after being diagnosed with bone cancer 2 years earlier. He received the Presidential Medal of Freedom just days before he passed. His son later recalled that even from his hospital bed, Walton was still reviewing sales data. He was 74. The company he left behind employed hundreds of thousands of people and generated tens of billions of dollars in revenue. His family never really left either. As of 2026, the Walton family still controls the company, with a combined net worth approaching $440 billion. When you buy a share of Walmart, you are, in a very real sense, buying into a family business. Just the largest one that has ever existed. So how does Walmart actually make money? Because in 2025, the answer is a lot more interesting than just selling stuff cheaply. Let's start with the three core business segments. Segment 1 is Walmart US, the main retail operation. Supercenters, discount stores, and neighborhood market locations. This is the engine behind the company's $681 billion in fiscal year 2025 revenue. That number is not a typo. To put it another way, Walmart's annual revenue is larger than the entire GDP of Switzerland. Segment 2 is Walmart International. The company operates in 18 countries outside the US with thousands of stores globally. Key markets include Mexico through Walmex, Canada, and China. The most closely watched international asset is Flipkart, India's largest e-commerce platform, which Walmart acquired a controlling stake in back in 2018 for about $16 billion. At the time, many analysts questioned the price. Today, with India's middle class expanding and digital commerce still early in its growth curve, Flipkart looks more strategic in hindsight. A potential IPO in 2026 is still on investors' radar. Segment 3 is Sam's Club, the members-only warehouse model that competes head-to-head with Costco. Sam's Club has said membership reached a record high, and it contributes a meaningful share of company revenue. It has also become an innovation lab for Walmart, piloting Scan and Go technology and AI-driven inventory management before those tools roll out more broadly. Here's where the Walmart story gets more modern. The company is building what it calls a flywheel, and that flywheel helps explain why investors are willing to pay a premium for the stock. Everyday low prices bring traffic. That traffic supports Walmart Plus, the company's membership program. Membership data, combined with purchase data from hundreds of millions of weekly customers, feeds Walmart Connect, the company's advertising business. Brands pay to reach those customers across digital and in-store services. That same volume also helps Walmart scale automated supply chains in a way smaller competitors cannot easily copy. Walmart Connect is the part of the business that Wall Street is watching most closely. In the third quarter of fiscal year 2026, Walmart Connect sales in the US grew 33% year-over-year. That matters because advertising carries much higher margins than retail. Every dollar of Walmart Connect revenue is more profitable than a dollar of grocery sales. As that business grows, it changes how Walmart looks on a profit basis. Then there's Luminate, Walmart's data platform. Suppliers use it to access Walmart's first-party shopper data and improve inventory and marketing decisions. What used to be an internal cost center has become a profit center. And in 2024, Walmart completed its acquisition of VIZIO, the smart TV manufacturer. That gives Walmart access to connected TV advertising inventory, opening another path for ad revenue. Together, these high-margin streams, advertising, membership, data, and fulfillment services, are becoming more important to Walmart's overall profit mix. That is the story the market is pricing in. Walmart is no longer just a retailer. It is a data and media company that also happens to be the world's largest grocer. Now, no serious breakdown is complete without looking at the bear case, and there are real risks here. Risk number 1, tariffs. This is the most immediate and politically charged challenge Walmart faces right now. A meaningful share of the goods on Walmart's shelves are sourced from China. The tariff regime implemented by the Trump administration in early 2025 created real cost pressure across the retail sector. In May 2025, Walmart publicly confirmed it would pass some of those cost increases on to consumers through higher prices. That created a political firestorm. For a company whose identity is built on everyday low prices, any sustained price increase is not just a margin issue. It is a brand problem. Risk number 2, valuation. Walmart is not a cheap stock. As of late 2025, it was trading at a high trailing price-to-earnings ratio. That is a multiple the company has not always sustained historically. Investors are paying for the growth story around technology, advertising, and membership. If that growth slows even a little, say, a weak quarter in Walmart Connect or slower Walmart Plus growth, the stock can re-rate quickly. Risk number 3, Amazon. Amazon has not slowed down. Walmart has made real progress in e-commerce, but Amazon still dominates US online retail. And Amazon is not just competing on price. It also competes on delivery speed, assortment, Prime loyalty, and advertising. Its ad business is already huge. That arms race is expensive. Technology, fulfillment, and same-day delivery all require heavy investment, and that pressure hits both companies. Risk number 4, internal margin pressure. Walmart's own earnings filings have pointed to higher variable pay, more technology spending, integration costs from VIZIO, and expanded marketing budgets. In other words, the company is investing heavily, but those investments create near-term pressure. Risk number 5, organized retail crime. Shrinkage, inventory loss to theft, damage, or admin error, remains a real drag across retail. Walmart has been lobbying for legislation to address organized retail crime, and it is investing in detection technology. But the issue is still there, and it affects margins that are already thin on the core retail business. So the bear case is straightforward: a richer valuation, tariff exposure, a relentless competitor in Amazon, pressure from ongoing investment, and operational costs that do not go away quietly. Those are real concerns. Let's talk about Walmart's history inside the major market indices, because the timeline says a lot about how the market has viewed the company over time. Walmart went public in October 1970. 2 years later, in August 1972, it listed on the New York Stock Exchange under the ticker Walmart. At that point, it was still a regional retailer with around 51 stores and $78 million in annual sales. A decade later, in 1982, it was added to the S&P 500. That was a meaningful signal. Walmart had crossed from regional story to national institution, large and liquid enough to sit inside every index fund and institutional portfolio built around the benchmark. Every passive investor who bought an S&P 500 fund from that point on owned a slice of Walmart. The next big milestone came on March 17, 1997, when Walmart joined the Dow Jones Industrial Average, replacing Woolworth Corporation. That move said a lot. The Dow is not just an index. It is a snapshot of American economic leadership at a given moment. Replacing a fading old economy chain with the world's most efficient retailer was a clear statement about where commerce was going. Then in early 2024, Walmart executed a 3-for-1 stock split, its first since 1999. A split does not change the company's fundamentals, but it can help liquidity and make shares more accessible to retail investors. The stock kept moving higher after that. Then came December 2025, when Walmart transferred its primary listing from the NYSE to Nasdaq. In practical terms, not much changed for investors. Same ticker, same company, but symbolically, it placed Walmart alongside Apple, Microsoft, Amazon, Alphabet, and Meta on Nasdaq. It was a quiet signal about how the company sees itself, not just as a retailer, but as a technology-enabled growth platform. Then in February 2026, Walmart crossed $1 trillion in market capitalization, becoming the first traditional retailer in history to do so. That put it in rare company. Here's a number to sit with. An investor who put $10,000 into Walmart at the 1970 IPO price of $16.50 per share would have built an extraordinary position over time, plus a large stream of dividends along the way. That is one of the great compounding stories in market history. Not from a semiconductor company. Not from a search engine. From a discount store in Arkansas. So what does the bull case look like? Growth level 1, the advertising engine. Walmart Connect is one of the most underappreciated parts of the business. Advertising has much better margins than traditional retail, and Walmart sits on a huge volume of first-party customer data. As brands adapt to a post-cookie world, real purchasing data becomes more valuable. That gives Walmart a stronger hand than many people realize. Growth level 2, Sam's Club. Sam's Club has laid out a long-term plan to double membership and more than double sales and profit over the next 8 to 10 years. It also plans to open 30 new locations and remodel its existing clubs. That makes Sam's Club a real growth engine, not just a side business. Growth level 3, Flipkart and India. When Walmart paid about $16 billion in 2018 for a controlling stake in Flipkart, the reaction was mixed. Today, the logic looks stronger. India's middle class is expanding. E-commerce penetration is still relatively low. And Flipkart's logistics and marketplace position continue to mature. A possible Flipkart IPO in 2026 could unlock value that is currently buried inside the broader company. Growth level 4, automation and artificial intelligence. Walmart is targeting a 20% reduction in fulfillment and distribution costs through automation, including robotics in distribution centers, AI-driven inventory replenishment, and smarter logistics routing. In late 2025, the company also scaled Sparky, an AI shopping assistant that helps handle customer queries and reordering across its digital platforms. Meanwhile, VIZIO adds connected TV advertising inventory, giving Walmart another way to monetize customer relationships outside the store. Growth level 5, the defensive angle. This part gets overlooked, but it matters. Walmart has historically gained share when consumers feel pressure. When budgets tighten, people trade down. They cut back on convenience. They look for value. Walmart tends to benefit from that shift. In a market dealing with tariffs, inflation, and slowing growth, Walmart's essential goods focus becomes a defensive asset. That combination, defensive, but still growing, is rare. Put it all together, and the bull case is simple. Walmart is a huge physical retail network being layered with high-margin technology and media revenue, backed by scale advantages that are hard to duplicate. And with a $1 trillion valuation, the market is finally pricing it a little more like the business it has become. So where does that leave us on Walmart? This is a two-sided story. On the bull side, Walmart has successfully pulled off one of the harder transitions in business, moving from a pure cost-driven retailer to a broader ecosystem with advertising, membership, logistics technology, and international e-commerce. The Walmart of 2026 looks different from the Walmart of 2016. It is being run with more of a technology company mindset, even though it still has thousands of physical locations. The market is starting to reflect that. On the bear side, the valuation leaves little room for mistakes. Tariffs are pressuring the company's core promise, Amazon is still aggressive, and the operating outlook has more moving parts than it used to. At a premium valuation, any miss in advertising or membership growth can hit the stock quickly. This is not a stock you buy for a fast double. It is a stock you buy because you think the transformation is real, durable, and still early. The patient investor may have plenty to like here. The trader looking for near-term upside has a tougher case to make. One last thing. Sam Walton started with $5,000 of his own money, a borrowed $20,000 from his father-in-law, and a failing five-and-dime store in a town most people had never heard of. He died in 1992 with his company employing hundreds of thousands of people. Today, millions of people go to work every day for a business he built on one simple idea: ordinary people deserve the same value that was once only available in big cities. Whether or not you own the stock, that is a story worth knowing. That is all for today. If you made it this far, thank you. I love to know where you stand. Are you bullish or bearish on Walmart right now? Drop your take in the comments below. And if there's a stock or a sector you want us to dig into next, tell me. Every suggestion gets read, and some become the next video. If this added value to your research, hit the like button. And if you're not subscribed yet, consider sticking around. We go deep on S&P 500 stocks, one at a time, every single week. See you